The deep dive this month is on ESG. We talk a lot about ESG, and I think we're going to be helpful for the viewers to just take a step back and give some background on sort of the ESG, the overall conversation, and what really, from a retirement plan perspective, we should be talking about when we talk about ESG.
Yeah, so maybe the best place to start is with a what is ESG? Broadly within this category, we are talking about investment strategies that incorporate non-financial elements related to environmental, social, and or corporate governance criteria. There's a lot of stuff that falls into those buckets. And so there's a lot of different types of strategies here. One of the most important things I always want to acknowledge when we're talking about ESG is it's really subjective. What I consider socially responsible is very different than what you may consider to be socially responsible, right? Now,
Absolutely.
I think fair to say, it's also very true. We talk about growth versus value. You and I could look at the same stock and I could say this is a growth company and you could say that's a value company. That's also somewhat subjective. But those distinctions are generally based on company financial characteristics, right? These things generally not based on company financial characteristics.
Yeah, so give me an example of when you say ESG, like give me an example of a company or an industry that would sort of be ESG favorable.
Well, I think the most common example that is non-favorable is energy. In most ESG funds, you will not find hardly any energy companies. That's kind of broadly known as an exclusionary strategy, right? I'm not going to invest in companies that don't meet or that have certain characteristics. The flip side could be true. You could have an inclusionary strategy where maybe you have a standard for a certain number of women or people of color on the board of directors or in the management team. And the strategy is only investing in companies that meet those criteria.
Yeah, and energy is a great example of one where you and I could have differences of opinion because producing energy is a necessity for life, and I think you look at companies that have good clean energy type policies and behaviors versus companies that have not so clean energy policies and behaviors. So just excluding energy as a category might not be
well, and even to get in more of a potentially, two investors could look at the same energy company in two different ways. There
Absolutely.
are activist ESG strategies out there that are saying, I'm out buying BP, I'm out buying Chevron because I want to get somebody on the board. I want to own enough stock that I can influence the policies of that company.
Absolutely.
Whereas other ESG strategies are saying, well, based on what the company is producing, we are not putting any money with them.
Yeah, absolutely. So let's maybe give us perspective on why an investor would want an ESG strategy in a retirement plan.
So it's a really interesting question. And I think we're seeing a lot of shift here. When we say an investor, as we talk about the participant first, why would a participant want an ESG investment strategy? I think there are certainly certain individuals out there that feel, some kind of moral obligation to align their dollars with their personal beliefs. I don't mean to sound so heavy-handed in saying that, but that's more important to them than other, exposures for their portfolio of not having certain exposures. There are investors out there that perhaps are looking for an ESG strategy because they want to use their dollars to influence certain agendas and support certain initiatives. That's another reason why an investor might want it. From a fiduciary perspective, it's quite interesting because we are seeing, of course, a lot of companies that have ESG goals. They're expressing those in their business practices, whether that's operations, whether that's hiring, sales, management, et cetera. And they're also feeling like, hey, maybe we need to be expressing those with respect to, what we're putting out here as well. So that's where it becomes really interesting of how do we make sure that doesn't conflict with executing fiduciary responsibilities. The name I'll give that, and I think we used to say this negatively, and I don't think it's a negative, but I'll call it performative ESG. Individuals that feel the need to outwardly perform ESG and therefore are looking for that as an investment strategy.
Yeah. So in terms of how widespread ESG is in the retirement plan space, give us some background on that.
So in the retirement plan space, not very is the answer to the question. Statistically, the various surveys would suggest about 15% of plans or so report offering ESG. That number hovered between 10 and 15% for years. And I would take this opportunity to remind you that most of these surveys are self reported. And so seeing a 2 to 3% swing in the numbers from year to year, we really can't read into that as a actual change in the rates. It's just differences in reporting and population surveyed. So, it's not predominant today, but we are definitely seeing plans that want to be leaders in the space where ESG is meaningful to them as fiduciaries, it's meaningful to them as a company, and they want to, explore this space. So we're going to see those numbers increase. But it's an interesting, I think it's a case of what comes first, the chicken or the egg. Like where did this ESG conversation come from? So maybe that's a good segue to look at the marketplace for ESG and kind of talk
Yes.
about how widespread that is in general.
I think we have a graph here we can throw up looking at the number of funds.
Yeah, if it feels like ESG came out of nowhere as this topic of frequent conversation, it kind of did. This is a chart that shows the number of funds that are self-described ESG investments. There was certainly a universe of the just shy of 200 funds going into 2019, but the number has grown exponentially. About 325 funds at the most recent reporting that are pursuing ESG strategies. These are just mutual funds. There's a whole universe in ETFs as well. One of the things I'll call out specifically in this chart, you can see in the white this new trend of converted funds. These are funds that previously existed that revised their investment policies and prospectuses to reference or incorporate ESG. There's been a term assigned to that called greenwashing. The skeptical side would say it's investment managers that want to capitalize on the demand for these products.
For sure.
The less skeptical side would say, it's folks that were repurposing existing asset bases. Maybe they realized, hey, we're pretty much doing ESG already, so why not make that more clear to our investors? But that's something to be mindful of and aware of out in the marketplace.
And largely because a lot of institutions that are looking to express an ESG position are now doing explicit searches for ESG type products.
Absolutely.
So
That's
if you have
the
product, you have an advantage.
Yes, and very much again, I think it's what comes first, the chicken or the egg. Like where did this institutional demand come from? And I think from our experience, it was coming because there was more conversation out in the marketplace about ESG because there were more products being launched, and so there's definitely a greater awareness. Corporate ESG push is having an influence here as well, where we see organizations again that they feel, hey, this is something we're preaching in all other areas of our business, and we need to reflect that here as well.
Yeah. So talk to me about, or talk to the viewers about fund flows and where we're seeing those fund flows.
Yeah, we can show you some data here as well. I mean, again, this goes to the what comes first, the chicken or the egg conversation. As you can see from the data, these are just flows into ESG strategies. Didn't really see them as significantly different from the broad market for most of the last decade. In fact, you can see kind of a lot of outflows post financial crisis, but that was a time of outflows from investment product in general. Definitely picked up in 2020. It definitely growing more dramatically than the product universe, which of course helps explain why the products are being launched so quickly here. But really starting to pick up from assets moving into these strategies. And that definitely takes us into kind of what does the market look like now? and we can show you some data on the size of this market. Something that gets lost a little bit in the conversation about ESG is it's not an asset class in and of itself. You can have an ESG investment strategy that's US equity focused, non-US equity focused, fixed income, all of the above. Most ESG strategies, as you can see in this chart, are focused in US equity. Fixed income, it's a pretty small marketplace, not a lot of allocation funds that are kind of doing a balanced portfolio. Almost 300 billion, so decent size. It's about 1.5% of invested assets in US dollar denominated funds. So if you're not investing in ESG, if you're not offering ESG, you are definitely in the majority with respect to how assets are allocated.
It's also what's attractive about it. It's only 1.5%, and the projections for where it's going are pretty astronomical. So people are really trying to capitalize on this movement right now.
And something that's an interesting angle that we've had some conversations about with clients as part of talking about ESG is, how do some of these strategies look and feel in a potential future state of the world? If an investment strategy may look compelling today, if it's saying, hey, we're only investing in companies that have, at least 50% of their management is represented by, women or people of color. Well, arguably there's a future world where that's how most corporate management looks. As standards are shifting, some of these practices that are today considered ESG practices may very well become standard corporate practices. So what does ESG then look like from an investment strategy in that type of world? I guess arguably there's always some other practices out there to be promoted, but just because a strategy focuses on promoting a certain specific goal or practice today doesn't necessarily make that sustainable.
Yeah, absolutely. Let's move on and talk about, I don't know how to frame it, but the opposition. There sometimes we get some very visceral, I'll use that word, reactions to ESG and its inclusion here. So maybe take us through some of the things we've seen in terms of opposition.
Yeah, for sure. I mean, I think it certainly is a tongue-in-cheek response, but some people have said, well, if you're going to give me the ESG fund, are you also going to give me the, guns, alcohol, and drugs fund? So we can give people both choices. I think fundamentally the concern about ESG, if you're asking the question, like, why does the regulatory environment keep changing?
Yeah.
Why are people, trying to move this needle? Why have people been trying to discourage it? The concern about ESG often is that in pursuing an ESG strategy, that there is either a need to give up returns or take more risk. That fundamentally there's a perception that this just isn't a valid investment strategy in a financial framework, and that specifically for fiduciaries who are responsible for overseeing other people's assets, that they're taking those assets and pursuing their own goals or the organization's goals, not the primary objective, which of course in a defined contribution plan is retirement. The Trump administration had, I think, a great quote that said, look, fiduciaries are responsible for a very important social goal, and that is saving for retirement, which I think is absolutely true. Now, is pursuing an ESG investment strategy in direct conflict? No, probably not.
Right.
There's definitely room that both could happen together.
Yeah, very, very great point here. In terms of the comment you made about giving up return, what have we seen so far in that respect?
Well, I'll say first, evaluating the efficacy of an ESG investment strategy, it's like the active versus passive debate. It depends on when you measure it and how you measure it, and you can reach a conclusion that would tell you one way or the other, right? Because at the end of the day, there's individual manager discretion here, and some managers are going to be more successful than other managers. So you can find studies that tell you both ways that ESG works, ESG doesn't work. Broadly, when you look at the performance of ESG benchmarks, the average ESG fund, the number one factor that's going to drive performance comparisons versus the broad market is sector exposure. Most ESG funds are underweight energy and overweight tech stocks that don't tend to have a lot of kind of direct I'll say, output, more service-based type companies.
Right.
So as those industries and sectors perform, so too does the relative performance of ESG usually trend.
Yeah, and we don't need to get into it here, but the performance evaluation and comparison of ESG investments, taking into consideration peer groups and things of that nature, can become a little tricky, and in terms of
Absolutely.
how you want to sort of express your ESG mandate here. So something definitely you should have a good handle on, right?
And I think, our position has been and continues to be within a defined contribution plan. The best way to demonstrate that an ESG investment is prudent is to hold it to exactly the same standards as we hold any other investment option. So if it's an actively managed strategy that is focused on US large cap growth companies, we're going to compare it versus the Russell 1000 growth, and we're going to evaluate it versus the large cap growth peer group. And it's got to
Absolutely.
meet the same performance standards as any other fund.
So what about in the case of an index fund?
Depends on your process for monitoring index funds. We would typically be saying, look, an index fund, we're looking for it to track its benchmark. And that's the core focus. And so if it's meeting that performance standard, works for us in a defined contribution plan. Again, another important item to reference, about why is there perhaps some opposition to ESG, specifically in defined contribution plans. There seems to be some kind of concern, maybe from the legal or regulatory side, that fiduciaries are going to rip out all of their current investment options and replace all those investment options with ESG funds.
Yeah.
We have had some companies that have talked about offering an ESG tier, maybe one day in the future, the way they offer an indexed tier that participants can get indexed exposure across asset classes. Maybe they can get ESG exposure across asset classes. We continue to believe, though, we want to look at ESG as additive, not replacing.
Right. I agree. The other area, maybe you can comment on this, that what we've seen some legal action on is in the index space, where you would think that an ESG index fund wouldn't be substantially more expensive than a regular index fund, but we do see product where it is quite a bit more expensive. So maybe you can talk about that.
Yeah, it's all in the eye of the beholder when you can buy an S&P 500 index fund for 3 basis points. Looking at an index fund that costs 10, 15, 20 basis points, it is factually true that is 3, 5, 10 times more expensive. Is looking at a fund, even an index fund on the surface, and saying this fund costs 10 basis points, an expensive fund? No, probably not. The other thing that I think has caught some folks, maybe by surprise, and when we've looked at ESG funds with clients, if you look at the top 10 holdings of the Vanguard FTSE Social Index, which is one of, if not the largest ESG index fund out there, it looks almost exactly the same as the S&P 500. Almost all the same companies. The weights are a little different, but it's a lot of the same companies. So I think there's been some questions asked of, are we really giving something that's all that much different here if the holdings are the same, and but paying more for it than the S&P 500 index? So there's certainly room for both. We know there's reasons why a company might want to offer ESG, but that's where that idea of not replacing could become really important.
I think it would be helpful if you gave the viewers some insight into some of the conversation we've had with clients and their perspectives and feedback they've given us on ESG.
Yeah, a couple of interesting tidbits. I think one common thread, I'll say, is maybe a small degree of disappointment in really digging into what's available in the ESG marketplace. If a plan is really wanting to offer something that is going to potentially have some significant non-financial impact, honestly, those products just really don't exist in a mutual fund space. These are generally not activist investment strategies that are partnering closely with companies. And, a lot of the strategies out there, they're very broad strategies, they're more exclusionary focused. And, a lot of clients have looked at a fund like the Vanguard FTSE Social Index and have said, there's a number of companies on this list that, you look at Amazon and say, oh, I don't like their labor practices. Or you look at Facebook, now Meta, and say, data privacy issues. So, thinking about what am I really going to get in ESG? I honestly think there's been some disappointment. I think also, we've seen a little bit of a shift, and truly, I sometimes going into the conversation, I don't know that people know if they want this, what they want, but thinking about like what is our objective here, and how do we execute that objective in a way that's in participant best interest, right? And I do think that's where we're seeing folks actually, I think, get more comfortable with ESG. We've had a few clients that 9 months ago they were like, "Yeah, we're not interested. That's just not exciting." That are now like, "Yeah, we want to talk about this and really seriously consider taking some action here." So it's an evolving landscape for sure. If you think about all those product launches we just saw, those products, the ESG marketplace of funds that have sufficient track records and assets and stable management teams, that's going to look a lot different in 3 years than it looks now. And, the types of even strategies being pursued are going to continue to grow and evolve. So it is a dynamic market, and I think it's going to continue to be so.
Agree. So just lay out for if someone's viewing this who's a fiduciary with overseeing a plan, lay out for me the sort of the key things they should be focusing on in addressing ESG right now.
Yeah. So I would say the most important things would be first, making sure that you're educated, that you really understand the range of strategies out there, that any managers you're considering, you understand what ESG means to that manager, what their portfolio looks like, how their performance compares to non-ESG benchmarks and to broad peer groups. Looking at the fees, making sure those are reasonable versus broad standards. And ultimately, that you have a good baseline and objective before taking action for what you are trying to accomplish. Would you want to offer an ESG fund?
Yeah. And is there any legal risk associated with sort of just ignoring this whole thing or fiduciary risk?
We very rarely, if ever, I'm racking my brain and not coming up with an instance. Well, I've got one, but rarely do we see, fiduciary breach litigation that says, you've breached your fiduciary responsibilities because of what you didn't offer me. Could it happen?
Yeah.
Sure. I'm thinking
will
of
happen.
one
Yeah.
instance where, there was a couple suits that said, hey, you didn't offer me stable value. You only offered me money market. I missed out.
Right.
But I think, the risk is somebody's going to have to demonstrate if they're going to say, hey, you didn't offer me ESG, you breached your fiduciary responsibilities. Okay. How was the participant harmed?
Harmed, right. Yep.
What harm was done? So
The harm was
I'm
to the climate, Alison.
I'm sure.
The polar
Or
bears.
to, if there's another Deepwater Horizon oil spill and stock prices
Yep.
fall and you should have known. But
Yeah.
as usual with imprudent investment cases, those are really difficult to win.
For sure. For sure. So fiduciary is just, I think, being educated on the topic, making sure you're talking about it and documenting those conversations. So you can always show that you're being a good fiduciary and considering things, right? That's usually
Absolutely.
the bottom line.
Yep.
Well, it's been great. Appreciate you and the consulting team at CAP STRAT doing such a great job on these slides and this research. And we'll look forward to next month's update. In the meantime, if you have questions on ESG, we have resources that can help you. So feel free to reach out to us and we'll let you know how we can help.
Thanks, everyone.